Welcome, warriors of UPSC. This is not just another lecture. This is your economic mass entry scene. Today, we decode the heartbeat of the India's economy, the financial markets of India, with the style of Thalaivar and the suspense of a Christopher Nolan climax. If you ever wondered how banks borrow overnight like it's Tinder swipe, or how IPOs are the red carpet debuts of the company, this lecture is your ticket. It's like Tony Stark funding Spider Man. The financial market funds the Indian economy. And hey, if you're watching this on YouTube, hit that subscribe button like RBI hits repo rate drops decisively and regularly. Alright, so what's on the menu today? So we are not just serving any dry theory today. We got a full course meal planned. Think of it as a blockbuster movie schedule. Okay, but instead of working on inflation and business cycle, we are into a thrilling sequel. It's actually understanding how the RBI pulls the strings in our economy, and it's not a pop quiz from a strict professor but a chance to solidify your newfound wisdom. We are into the lecture 20, the Indian financial market today, so prepare for some mind bending concepts that will make you feel like a financial superhero. So this concept is particularly important for prelims in particular. Okay, so let's get into the lecture. Let's kick off things with a grand introduction. Like, imagine financial markets as the unsung heroes of our economy, the real life money savers. They are like the express highway connecting those who have spare cash to those who desperately need it for growth, who are the investors. Without them, your hard earned savings would just sit under your mattress, gathering dust and contemplating the meaning of life instead of being put to work to build factories, invent new tech, or maybe even fund the next big movie. These markets broadly split into two main acts, that is the money market and the capital market. Think of them as the dynamic duo, each of with its own superpowers, ensuring the flow of funds. See, think of the financial markets, okay, make it simple, as India's matchmaking app, but for the money. Okay, they connect people who have surplus cash, with those who have brilliant ideas. Like as we look into it as money market, like it's a short-term drama, like a summer fling, which is over in less than a year. But capital market, it's a long-term bond. Okay, not just through emotional thing, but through financial aspect. So let's start into the money market. First up is the money market. It's like the fast-paced short-term sprint of the financial world. Like, we are talking about funds with a maturity period of less than 1 year. See, this is where banks, financial institutes, corporates, and even the government come to get their urgent cash fixtures. Need to cover a temporary deficit? Money market is always to the rescue. It's primarily regulated by the Reserve Bank of India, our very own financial big boss, keeping an eye on everything. So it's regulated by RBI, and everyone borrows funds to meet their shortcomings or temporary deficit. This is like the Formula One track of finance, fast, furious, but very short term. The money market deals in funds with maturity over less than 1 year, where RBI is the pit crew chief here. Participants includes banks, corporations, and governments, all doing one night stand borrowing. See now for the instruments, okay, in this market, which are essentially the tools they use. Treasury bills, also known as T-bills, these are like IOUs issued by the government of India. Okay, instruments issued by government of India. They don't pay direct interest. Instead, you buy them at a discount and get the full face value at the maturity. It's like buying a movie ticket for rupees 90 and getting a 100 rupees refund after the show. Isn't it pure genius? See, they come in 91, 182 or 364 days maturities. The RBI conducts weekly auctions, and as of July 2025, treasury bills are around 5.54% per annum, influenced by the RBI's repo rate, risk-free, zero coupon, government issued. Basically, the Amitabh Bachchan of finance, reliable and always evergreen. Commercial paper. Think of these as unsecured promissory notes. Okay, unsecured promissory notes issued by big corporations to raise short-term funds. It's like a company saying, "Hey, we promise you to pay back in few months. No collateral needed. Just trust us. We are highly rated. Highly rated. They mature from 7 days to 1 year and are used as for working capital needs." The RBI has even streamlined the regulations for commercial papers, prohibiting physical issuance and imposing a 25 limit on individual subscriptions and primary issuance. Big corporations, stylish instrument, but it's high risk and also high return. Next comes the certificates of deposits. They are negotiable instruments issued by commercial banks and all India financial institutions like NABARD, Exim Bank, SEBI or National Housing Bank. See, if a bank needs short-term deposits, they have certificates of deposits. They are the fixed deposit but can be traded. What's the minimum investment? At least 1 lakh. As of July 2025, deposit rates range from 3 to 7%. Banks borrowing from you without drama is certificates of deposits. Next one is call money market, a market for very short term overnight borrowing and lending of funds between banks. This is the blink and you will miss it market for overnight borrowing and lending between banks. It's like banks playing musical chairs with cash to meet their daily requirements with the RBI. Unsecured lending, and guess what? Financial institutions like LIC can only lend, not borrow. It's like being a party where you can only offer drinks, not ask for one. The RBI's repo rate cuts directly impact these rates, keeping them within a tight corridor. So it is very much important for in the call money market to keep it very tight by the RBI so that the borrowing does not exceed certain limit. Now for quick reality check, prelims PYQ slide. This is where we will see if you have been paying attention or just dreaming about your next meal. Let's look at this 2018 question. Consider the following statement. The Reserve Bank of India manages and services of the Government of India but not of state government securities. Treasury bills are issued by the Government of India and there are no treasury bills issued by the state governments. Treasury bills are often issued at a discount from the par value. Okay, these are the 3 statements. So now let me give you a few seconds. So we just discussed this, right? Buy low, redeem face well. Just take your time and think of it. Okay, so let me start from statement 1. The Reserve Bank of India manages and services Government of India securities but not of any government securities. See, this is false. Okay, RBI manages both government and central and state government securities. This is like saying central government cares about its kids but not its cousins. No, that's not true in the financial world. So this is wrong. Treasury bills are issued by Government of India and there are no treasury bills issued by the state governments. See, this is true. Treasury bills are exclusive of central governments. State governments have their own ways of borrowing. Okay, so it is true. Next one is Treasury bills are issued at a discount from the par value. We just discussed it in the previous slide. So buy low, redeem at face value. It's a T-bill magic trick. So the right option is option C, 2 and 3. So let's get into the next topic, the financial intermediaries. Moving on to our financial intermediaries, or you can call it financial matchmakers. These are the unsung heroes who connect the savers, like those with a surplus of funds, like me after I got my last bonus. Just forget it, I was kidding. And the borrowers, those who need funds, like me, eventually at the end of every month. They make the whole process smoother, cheaper, and less risky. Think of them as the Avengers of finance, each with a crucial role. Commercial banks, the OG superheroes. Okay, they accept deposits, give out loans. They are everywhere, like that annoying relative who shows up at every family function. Like as of May 2025, credit growth of Indian banking sector is at 8.97 percentage a year on year. Every year it is going at 8.97 percentage credit growth. Next one is non-banking financial companies. The cool, slightly rebellious cousins of banks. They offer a ton of financial services but can't accept demand deposits. That's very bad. Mutual funds, the ultimate team players. They pool money from many investors to invest in a diversified portfolio. It's like a financial potluck where everyone brings a little and you get a taste of everything. Next one is the insurance companies. Our financial guardians collecting premiums to protect us from various risks. Because let's face it, life is always unpredictable, and sometimes you need a financial safety net bigger than your ego. One more point is, it's repeated here, so let's keep it as pension funds. Okay, it's like managing your retirement savings so you can finally afford that world tour you've always dreamed of instead of just scrolling through regular travel logs. So let's get into the next lecture. What is the role of the financial intermediaries? See, besides looking important, they have some pretty vital roles, like the supporting cash in a blockbuster film. First one is mobilization of savings. They collect all those small savings and turn them into a giant pool of productive investment capital. Think of it as collecting tiny drops of water to fill a massive dam for irrigation. That's mobilization of savings. Next one is allocation of capital. They direct funds to the most efficient and productive users, essentially playing a financial matchmaker between demand and supply. It's like a financial GPS guiding money to where it's needed most for the economic growth. Risk transformation. They take risky assets and through diversification make them less risky. It's the financial equivalent of putting all your eggs in different baskets, so if one falls, you don't lose all. So that's risk transformation. Maturity transformation. They match short-term deposits with long-term loans. You deposit for a month, they lend for a decade. It's a financial alchemy. And finally, it's liquidity provision. They offer various financial products that make it easy for investors to convert their investments into cash. Like imagine having a cash in your pocket when you need it instantly without even selling your car. So that's liquidity provision. That's what role of financial intermediaries do. Now moving on with that, now let's enter into the capital markets. This is the long-term game, the marathon of the financial world. We are talking about funds which are needed for more than a year, funding grand visions on long-term projects. See, if money market was Tinder, capital market is Shaadi.com. Long-term relationships only. The key instruments here are, first one is stocks. Stocks, the glamour of the market. See, when you buy a stock, you become a tiny part owner of a company. Yeah, you heard that right. You are literally a co-owner, even if your ownership stake is smaller than your pinky finger. You get a claim on their asset and earnings. These are the equity shares and preference shares, but still, you own the company. Stocks means it's ownership. Next comes bonds. If stocks are about ownership, bonds are about lending. It's about lending. Okay, you lend money to government, public sector undertakings, or corporations, and in return, they promise to pay you regular interest and principal money back at maturity. It's like giving a loan to your friend, but with official paperwork and guaranteed returns. Bonds offer fixed income and are rated by credit agencies. Types include government bonds, corporate bonds, and even sovereign gold bonds. So, bonds, in the sense, you can call it debt or you lend it. Next one is debentures. These are big type of bonds issued by company, but usually unsecured, meaning this means they are not backed by any specific asset. Their repayment depends on the company's credit worthiness. It's like lending money to a friend based purely on their reputation, not on what they own. They typically offer fixed interest rates and can be convertible or non-convertible as well. Now we'll be looking about the primary market, which is IPO. Like, welcome to primary market, often nicknamed the new issues market or famously the IPO market. This is where companies for the first time go from being private clubs to public parties. An IPO, or even called as initial public offering, is essentially when a private company offers its share to the public for the first time to raise capital. Okay. Why do they do it? To expand. Okay, expand, pay the debt, repay, or do R&D, or even general corporate purposes. Okay, uh, the process is quite a journey, like a movie production, like preparation, draft red hearing prospectus, SEBI approval, road shows, book building, allotment listing. That's a lot to go. The Indian IPO market is currently buzzing with names like Reliance Jio and Tata Capital lined up for 2025. It's like every week there's a new Bollywood star making their debut. So that's primary market. Next is secondary market. If the primary market is where the new securities are born, the secondary market is where they live, breathe, and get traded among investors. Like, think of it as a vibrant, bustling bazaar where already issued stocks, bonds, and debentures change hands. This is where the magic of liquidity happens. You can buy or sell securities easily. Its key function is its grand platform for buyers and sellers to interact, facilitating price discovery based on demand and supply. It's like never ending negotiation where everyone tries to get the best deal. See, in India, our major stock exchanges are NSE and BSE. The secondary market crucial plays a crucial role in the economy by providing liquidity, that is the ability to convert investments into cash easily, price discovery, which shows real-time prices reflecting collective investment judgments, capital allocation, efficiently directing capital to well-performing companies, and investor protection, investor protection regulated by SEBI to ensure fair play because nobody likes a rigged game. So moving on with the different types of investment vehicles. So as we understood the markets, but how do you actually drive in them? We need the right investment vehicles. These are the fancy cars, bikes, or sometimes even rocket that take your money on a journey. Mutual funds, a professional financial instrument that pools money from investors and invests in a diversified portfolio. Like think of it as a shared taxi where everyone pitches in and a professional driver takes you to the destination, spreading out the risks. So that is mutual funds. Next is hedge funds. These are the fast and furious of investment vehicles, aggressively managed and used advanced strategies like leverage, long, short, and derivatives to generate high returns. These are high risk, high return, less regulated than mutual funds, but require high minimum investments and are less liquid. Basically, not for the faint heart or the light of wallet. In India, their structures add as alternative investment funds, specifically category 3 AIFs. Hedge funds are aggressive and very risky. Next one is capital funds. This is a broad term but often refers to certain aspects, certain different types. Private equity, investing in private companies to improve performance and then exit. Like think of them as financial surgeons operating on companies to make them healthier. They come under category 2 of alternative investment funds, AF or category 2. Next one is venture capitals. It's a subset of the private equity funds and specifically invest in early stage high growth startups. They don't just provide capitals, they also offer mentorship. These come under category 1 of alternative investment funds. Next one is infrastructure funds. Investing in big infrastructure projects like roads, power, ports for long term returns because well, someone has to always build those superhighways, right? It's also a category 1 alternate investment funds. See, unlike those mutual funds, these capital funds are usually close-ended and privately placed, like meaning they are not for every Joe and Jan in the street. Another prelims PYQ challenge. Don't worry, no one's getting eliminated from the show. What does the venture capital mean? We just discussed it. Short-term capital provided to industries, long-term startup capital provided to new entrepreneurs, funds provided to industries at times of incurring loss, and the funds provided for replacement and renovation of industries. Just take your time and remember, we just looked into it. Yes. And the answer is the long-term startup capital provided to new entrepreneurs. If you remember our discussion, venture capital is all about those early stage high growth potential companies, the disruptors, the innovators. It's not about short-term fixes or bailing out making loss ventures. It's about nurturing the next big thing, or we can call it the Iron Man of the startup world. That's venture capital. So with that, we are coming to the end. Aspirants, you have danced through the treasury bills, soared over the IPOs, and made a stylish entry into the mutual funds. If this lecture has sparked even one idea, imagine what subscribing will do. You have mastered financial markets, solved UPSC PYQs, and done it in Thalaivar style. Smash that subscribe button harder than Elon Musk tweeting at midnight. One video can inform, a subscription can transform. Stay tuned, stay curious, and keep walking the learning through Thalaivar way, as learning is always legendary. Jai Hind, Jai Economy.